Have you ever felt like the Forex market is out to trap you? You enter a trade and suddenly the price goes the other way. What if I told you there's a pattern that reveals the hidden logic behind the chaos? It's called the Forex Master Pattern, and it holds the secret to understanding every major move in the market. In this video, we're going to break down this exact structure step by step. The three core phases that control when smart money enters, expands, and exits the market. This could completely change how you trade forever. So stay with me till the end, because this is not just a strategy, it's the foundation of market structure. The image you're seeing right now is called the Forex Master Pattern, a simplified map of how price behaves in all time frames. It's broken down into three clear phases: contraction, expansion, profit-taking, trend. These phases repeat over and over in the markets, whether it's EOR, USD or gold, M15 or H4. Let's break them down, with real logic behind the moves. We begin with contraction. This is the phase where the market compresses. Look at the left side of the image. Price is ranging, moving sideways, bouncing between support and resistance. This is where liquidity builds up on both sides. Smart money, institutions, banks, they want one thing: liquidity. During contraction, they accumulate orders, trap retail traders, and create a false sense of balance. Most traders lose money here, taking breakout trades too early or getting chopped by false signals. But smart traders know contraction is not for trading, it's for watching. You wait patiently for the real move to come. The blue zigzag range on the left represents this phase. It's boxed in, showing indecision, low volatility, and price hovering around the average. Then suddenly, boom, price breaks out. This is the expansion phase. This breakout is not random. It's the result of smart money triggering stop hunts, liquidity grabs, and initiating a large directional move. In the image, notice how price breaks structure aggressively. This red zigzag drop is designed to move price away from the average, often targeting liquidity zones. This is where smart money is entering positions. After accumulation, now comes manipulation. But here's the trick. Expansion often comes with a false breakout first. Price may spike one way to trap traders, and then go the opposite direction. This is why traders must understand the break of structure and never chase price. Let the move confirm and only then engage. This red, jagged move down after contraction shows the manipulation. Expansion can be violent and quick. It sets the stage for the real trend. Now we enter the third phase, profit-taking, or what many traders call the trend phase. This is where the real directional move begins. Smart money has already built positions and moved price. Now they ride the trend to maximize gains. Retail traders usually enter here, late, but that's okay because this is often the cleanest part of the move. In the image, notice how price forms higher highs and higher lows, represented by the green zigzag. It's now flowing smoothly. This is where we use tools like Fibonacci, market structure, and trendline confluence to enter. The secret here: buy low in the trend, don't chase the top. Use retracements smartly. The upward green line after expansion, labeled profit-taking, shows the beginning of a well-structured bullish trend. The shaded retracement zone is ideal for re-entries. Between expansion and the full trend, we often get mini-cycles or retracements. These are short pullbacks where price returns to a fair value, giving another chance to enter before the full trend. This is your sniper moment. Wait for the retracement to tap into order blocks, imbalances, or previous structure, then strike. The arrow labeled Retrace Mini-Cycle shows exactly where smart traders wait for price to come back to them. Now here's a hidden gem. Throughout all three phases, price is dancing around an invisible line, the average price. This average line is the gravity point. No matter how far price expands, it always returns eventually. Tools like VWAP or moving averages can help identify it, but smart structure reading is the key. Never forget, markets expand away from value, but always return to it. To master this structure, in contraction, mark liquidity levels. Wait. In expansion, watch for manipulation, confirm break of structure. In trend, ride the move using structure, retracements, and trailing stops. Repeat this cycle on any pair, any time frame. It's fractal. It works everywhere. And remember, it's not just a pattern, it's the language of the market. EUR/USD on the 1 hour time frame is one of the best educational tools to understand what's really happening behind the scenes. So stay with me till the end, and by the time this video is over, you'll be able to read the market like smart money does, cycle by cycle. Let's begin on the far left side of the chart. Here, you'll notice a large red box labeled down cycle. Look for shorts only. This is a bearish cycle, where price is forming consistent lower highs and lower lows. In this phase, the market structure is clearly to the downside, and sellers are in full control. The red arrows highlight the impulsive bearish moves, while the blue arrows represent small pullbacks, which should not be confused with reversals. Smart traders during this phase only look for selling opportunities, ideally entering on retracements, trendline rejections, or order blocks at lower highs. Trying to buy in a down cycle is like swimming against the current. It rarely ends well. As the downtrend begins to lose momentum, price enters a range, still inside the broader down cycle. This section is labeled range within down cycle, trade edges only. Here, price is compressing. Smart money is either taking profit or preparing for the next move. This is a trap zone for retail traders. The middle of the range is full of fake-outs, so the only smart way to trade here is to focus on the edges. Short at resistance, take profit at support. This strategy helps you avoid unnecessary losses and stay aligned with the dominant cycle. Eventually, price breaks above the range and the descending trend line. This is your first clue of a structure shift. Now, the market transitions into a new up cycle. Look for longs only. This phase is the opposite of the earlier downtrend. Here, price forms higher highs and higher lows, and bullish momentum takes over. Notice how the blue arrows now show strong upward impulsive moves, while the red arrows become shallow pullbacks. In this environment, your job as a trader is to buy the dips, enter on pullbacks to structure, order blocks, or trendline support. Trying to short an upcycle is a mistake. You're going against the structure. In the middle of the uptrend, price again slows down and begins to move sideways. This time, we enter a range within upcycle, trade edges only. Just like before, this is a decision zone. Smart money is either adding to their positions or preparing for a reversal. Once again, trading the range edges is the only safe strategy. Wait for price to reject key levels and don't get caught in the chop in the middle. Now take a look at the Fibonacci projection levels marked across the chart. These levels, 100%, 200%, 300%, even 400%, are key extension targets based on previous swing measurements. They help traders identify where trends may pause, reverse, or take profit. For example, when the market is in an upcycle, the 100% and 200% Fibonacci projections become excellent targets for bullish trades. Similarly, in down cycles, Fibonacci extensions help locate areas where price may react. As price reaches these levels, volume drops, momentum fades, and smart traders exit with profit. After hitting these upper fib targets, price fails to make new highs and starts to reverse. This is your second structure shift. The upcycle ends and a new down cycle, look for shorts only, begins. Structure flips bearish again, price forms lower highs and lower lows, and you'll see another red boxed area labelled with the down cycle. The same logic applies, no more longs. You now switch to shorting pullbacks, respecting the new bearish structure. As the new downtrend progresses, we again see a range zone appear within the cycle, labelled Range Within Down Cycle, Trade Edges Only. This is yet another pause in the trend, and once again, it's not the time to overtrade. Stick to the edges, short from resistance, and take profits at support. Toward the far right of the chart, we see a final attempt to break lower, but price begins bouncing, possibly suggesting another phase of contraction or early signs of reversal. But remember, as long as price remains in the down cycle, smart traders stay cautious and look for shorts only unless structure flips again. In conclusion, this chart beautifully teaches us the repeating nature of market cycles. From downtrends to uptrends to ranges, the market gives you clear clues, if you know where to look. Trade with the cycle, not against it. Use Fibonacci projections for profit targets. And always respect the current market structure, whether you're a beginner or advanced trader, understanding these cycles will massively improve your decision-making, your entries, your exits, and your confidence. If this video helped you make sense of the chart and structure, make sure to hit the like button, subscribe to Financial Freedom FX, and drop a comment below. Which cycle do you struggle with the most? Uptrend, downtrend, or range? Let me know, and I'll make more videos to help you master it. Thanks for watching, and remember, smart traders trade structure, not noise.